Welcome back. I want to finish out this chapter by talking about times where courts will agree to enforce promises that don't amount to a contract. Remember how we defined contracts as a promise or a set of promises that the law will enforce. Well, what if we have parties who make promises to each other that for one reason or another don't amount to a contract? The law won't enforce them as a contract, but it would be unfair not to enforce them in some way. Is there any theory of recovery or method by which a court would agree to enforce a promise? Well, the first theory we're going to look at here is promissory estoppel. This is what I call an equitable remedy that the court provides. This is a remedy that a person would ask the court to give them where, by definition, a contract does not exist. Right? A promissory estoppel is used where there's a promise that is made by one party to another that the receiving party would rely upon to their detriment. Right? Let's take a look at the elements, then I'll give you a real-life example of a case that I had once with the promissory estoppel as the issue. Promissory estoppel, sometimes called detrimental reliance, requires these three elements. First, you have to have proof that the defendant made a clear, unambiguous promise, knowing that the plaintiff would likely rely on that promise. Second, there must be proof that the plaintiff did reasonably rely on the promise. And third, that the only way to avoid injustice is to enforce the promise. Right? Sometimes we call this detrimental reliance, or relying on a promise to your detriment. Let me tell you about a real-life case that I had several years ago. You may or may not know that a big industry in our area here in Western Illinois is agriculture. And so a lot of my clients were farmers. And I had one client who was a pig farmer. And he was the type of pig farmer who would take baby pigs and he would feed them and grow them to a certain weight, a market weight, and then he would sell them and then they would be bacon. And this farmer was contacted by a broker for another farmer, a pig broker, if you will. I didn't know they existed, but it's a thing. So the pig broker contacted my client, the pig farmer, and he made some promises and he proposed a contract. And the pig broker said, I can promise to deliver you a certain number of pigs every week or every month at a certain price over the next 2 years. And so he made an offer for this contract. And my client even saw a couple of drafts of the contract. There was a lot of discussion and negotiation about the terms of the contract. And they were very serious about it. In fact, my client felt that they were serious enough that he went to his banker and he borrowed some money to expand his hog facility to make room for the new pigs that were going to be acquired under this contract. He actually had a line of credit for somewhere around, I think, $500,000, and he'd begun construction on a new hog barn and spent, I think, around $50,000 at the point at which the pig broker told him that there would be no contract. And so he backed out. My client then came to me and said, is there anything we can do? I just spent $50,000 and now I learned that there's not going to be a contract, there aren't going to be any pigs. Is there a way we can sue him? And I said, well, first of all, we don't have a contract, right? You never actually entered into the contract with the broker or the other farmer for the pigs. You were still in the negotiation phase. There was never offer and acceptance. So we didn't have an agreement, and therefore we don't have a contract to enforce. However, you did rely on some very specific promises that the broker made to your detriment, right? So let's run our real-life example through the elements of promissory estoppel. First, that the defendant, and in my example that would be the pig broker, made a clear, unambiguous promise knowing that the plaintiff would likely rely on it. So in my example, the pig broker did make some very clear, very specific promises about certain numbers of pigs and the weight of the pigs and the price of the pigs and the term of the contract that was proposed, and made some very specific promises about delivering these things. Second, that the plaintiff, that would be the farmer, did reasonably rely on those promises. Well, I mentioned in the facts that the farmer did rely on the promises to the point where he went out and borrowed money and spent about $50,000 of that money to begin construction. And last, that the only way to avoid injustice or unfairness would be to enforce the promise. In other words, was there detrimental reliance? Did the farmer rely on a specific promise to his detriment? And in this case, the detriment would be the expenditure of $50,000 that he otherwise would not have spent. Right now, I can't tell you the answer to whether this truly was, or whether a court would agree that this was promissory estoppel. It certainly seemed to meet all the elements, but I had to withdraw from the case to begin teaching at that time, and so I don't know whatever happened with the pigs. But I have a feeling that the parties settled the lawsuit because he had a good claim for promissory estoppel. Now, just to recap and to make sure that you understand what this theory of promissory estoppel is all about. This is a way of recovering on a promise that's made by one party to the other that doesn't amount to a contract. If the promise results in detrimental reliance, then a court might entertain promissory estoppel. Okay, the next theory of recovery that we come to in what I call no contract contracts is something called quasi-contract or quantum meruit. This is also referred to sometimes as unjust enrichment, right? And we can see the elements here. First, that the plaintiff gave some benefit to the defendant. Second, that the plaintiff reasonably expected to be paid and the defendant knew this. And that the defendant would be unjustly enriched if he did not pay. Now again, this is a theory of recovery that a plaintiff would use where there is not a contract that exists. Let me give you an example of this, and then again we'll run it through the elements. Again, this comes from the agriculture industry. Let's just take a hypothetical, though, and we'll talk about a farm lease, because this happens from time to time in farm leases. So let's say we have a hypothetical farmer. We'll call him John Deere, and our hypothetical farmer wants to lease some land to put crops on. You may or may not know that crop leases usually last from the spring to the fall, usually April to November. That's considered a year for terms of a crop lease, right? They're not calendar years, but they're crop years, so they go from the spring to the fall. And so Mr. Deere contacted Mr. Landlord and entered into a lease, and the lease was from April to November for a stated amount of money. So Mr. Deere planted his crops in the summer or in the spring, and then harvested them in the fall. And then, like a lot of farmers will do, at the end of the crop year, we'll start to prepare the land for the next year's crop. And sometimes farmers will put down chemicals or fertilizers and do some work, labor, spend fuel with their tractors, putting value into the land to prepare it for the next year. Well, let's say that Mr. Deere, at the end of November, beginning of December, spent some money and fuel and all kinds of labor to prepare the land that he had leased the prior year for the next year's crop. When spring comes along, Mr. Deere and Mr. Landlord get together to negotiate that year's lease, and they can't get together on a price. The landlord has decided to increase the rent, and Mr. Deere has decided he doesn't want to necessarily pay that high rent. So Mr. Landlord finds another tenant. We'll call him Farmer in the Dell, right? So Farmer in the Dell, he signs the lease for the next year's crop. Well, what about the land and the money and the effort spent in the fall to prepare the land for the next year's crop? Didn't Farmer Deere increase the value of the land and give a benefit to the landlord in the fall, and not then reap the benefits of that for having the next year's lease? And you can see as we go through our elements of quantum meruit there that Mr. Deere may have a claim for quasi-contract. First, the plaintiff gave some benefit to the defendant. In my example, the plaintiff here would be the farmer, Mr. Deere. Did he give some benefit to the landlord? And the answer there is yes. He gave a benefit. He prepared the land with chemicals and fertilizer and labor for the next year's crop, which would definitely benefit the land, making it more valuable for the next year's crop. Second, the plaintiff reasonably expected to be paid, and the defendant knew this, right? The Farmer Deere might have expected to be paid in the sense that he could have profited from the next year's lease and from his labors, and the defendant knew this. This is usually the type of service and goods that one expects to pay for, right? Most landlords don't expect to get fertilizers and chemicals for free. And last, that the defendant would be unjustly enriched if he did not pay. So in this case, would it be unfair for the landlord to take the benefit of Farmer Deer's work and his expenditures in the fall, and then pass those benefits along or keep them? And the answer there is probably yes, right? And there are some cases with these facts where courts have determined that, yes, even though there was no contract existing between the farmer and the landlord at the time the farmer completed the work, that it would be unfair for the farmer not to be paid back, or reimbursed at least, for the amount that was spent in preparing the land for the next year's crop. Okay, last, what I want to talk about here is where our contract law comes from. And if we could look at the next slide there, we'll see that there are really two main sources of contract law. The first is the common law. Common law, of course, is judge-made law made by precedents over time, right? When a court makes a decision, that creates a precedent for the next court, and through this body of decisions, we can kind of determine what rules the courts are going to use in the future. That's where most of our contract law comes from. It's from the common law. And we find that in a compilation called the Restatement of Contracts. It's basically a series of books that compiles all of the different precedents that are out there in the area of contracts, and we can go and look and see what the general rules are. Now, I will say this, that the common law usually is state law, and it varies from state to state because each state has a different history and different precedents that it relies on, and so sometimes you'll get slight variations in the common law. So what may be the rule in one state under their common law may not always be the rule everywhere. When this happens and when we encounter some differences, I'll try to alert you to them. And usually what we have is a majority of states that follow one rule, and maybe we have a minority or a few states that follow a different rule. But for the most part, the contract laws that we're going to be looking at from the common law are fairly general and apply everywhere. Okay, so we have one source, which is the common law, but then we have another very specific source of contract laws. That is the UCC, the Uniform Commercial Code. Specifically, Article 2 is what we're going to be talking about. The Uniform Commercial Code is a uniform set of laws that have been passed by the state legislatures of every state. So let's say 80 or 90 years ago or so, a bunch of lawyers and judges and law professors got together and they looked around at the common law of contracts, and they said, you know, the rules are slightly different depending on where we go. So the rule in Illinois may be different than the rule in Texas, maybe different than the rule in California. Wouldn't it be better, wouldn't it be more efficient if we streamlined these rules and made them all the same or uniform? And so they got together and they drafted a model set of rules for a lot of commercial transactions, and they put those together in what we call the Uniform Commercial Code. Article 2 of the Uniform Commercial Code deals with contracts and contract laws. In fact, Article 2 deals with a specific subset of contracts called sales. And that's what I want to focus on. And that's what we'll be focusing on in the next several chapters as we look at the rules of contracts. Article 2 of the UCC governs contracts for the sale of goods. Okay, so from now on, whenever you encounter a contracts question, the first thing you have to ask yourself is this a contract for the sale of goods? Because if the answer is yes, you might find that you'll have different rules to apply. And the rules of contract formation, especially under Article 2, are very different, we'll find out, than the rules of contract formation under the common law. So, very important question, is this a contract for the sale of goods? Well, in order to answer that, we have to know what are goods. Goods, defined by the UCC, are tangible personal property, things. A lot of the personal property that you can think of, computers, furniture, clothing, even animals are considered goods. Tangible personal property is property that you can pick up and move around. Those are all considered goods. So any contract you have for the sale of tangible personal property, things, are going to be governed by Article 2 of the UCC. Right? What are not goods? Contracts for things like services. If I come to paint your house or prepare your tax return, right? Those are services that I provide. That's not a good. So any contract for those services would be governed by the common law. All right, and as we go forward, we're going to be looking at rules, especially in the next chapter, of the rules of agreement, offer, and acceptance. We're going to find out that the rules between the common law and Article 2, the sales contracts rules, are very different. And I'll alert you to those things, but just to put you on notice that is the case. Well, one question that comes up from time to time is, how do we know? Sometimes we have contracts that involve both goods and services. So if we have a contract that involves goods and services, how do we know which law applies? Are we going to use the common law of services, or are we going to use the UCC Article 2 rules for sales contracts? Well, the courts have developed a test for this to determine which set of laws we're going to use. And it's on the slide there, called the predominant purpose test. Right? So the courts will ask the question, what's the predominant purpose of this contract? Is this predominantly the sale of goods with some services? Or is it predominantly services with a few goods? An example, if I'm going to come paint your house, and you're going to pay me to do that, and we enter into a contract, well, what I'm primarily providing you is painting services. Now, I will use some paint, right? And you will have to buy that paint as part of the contract. And the paint is goods because it's tangible personal property. You can pick it up and move it around. However, predominantly, what you are paying for are the services that I'm providing. Me doing the painting, the labor, right, with some goods thrown in. So applying the predominant purpose to that contract, we'd find out that we would use the common law rules of contracts. Now, there's a case that's reported in your textbook. It's listed on the slide, Fallsview Glatt Kosher Caterers, and it's about this very test. So go ahead and read through that and make up your own mind about whether you think that is a contract predominantly for goods or predominantly for services, whether you agree with the court.